Good morning, everybody. This is Gary Fullerton, LTGLC Trading Company. We'll wish everybody a good Saturday morning from the Chicagoland area. I would like to go over the S&P 5-minute chart of yesterday to show you how important trend is and where to look for an edge in the market. This is something that is extremely important in trading, and especially the Wyckoff, is to follow the trend, which is the path of least resistance, and where the edges are for yesterday to look for a particular trade for possible entry. Let's first do our disclaimer. There's a substantial risk of loss in trading commodity options. Past performance is not indicative of future results. The opinions of those of Gary Fullerton, LTGLC are not to be taken recommended to buy or sell commodity options. This is for the educational purposes only. And basically, commodity trading is extremely risky, and 90% of people that trade lose money. So having said that, I want to go over the edges in the market of yesterday, and I think they're very, very important, because I think that when you follow trend in the market, it's much easier to look for edges than trying to buck the particular trend. And I think what is important is that you try to follow trend as much as you possibly can, because this allows you to go in harmony with the market. We all hear about following the trend, but a lot of us don't follow trend because we think that we can buy the low and sell the high. This generally is not necessarily a good idea. Some people could be successful in doing it. I think most people are not successful in doing it. Trade is difficult enough. So the key, in my opinion, is to try to look for possible edges of trades. If you make a particular trade that fits your particular parameter, then make the entry into the trade with the appropriate stop and go from there. So I'll talk a little bit about the market and where the market has edges. And in a short video, I will show you the act of distribution, or the market having these particular selling tails for further lower prices. As we know, as I talked in the other videos, the composite operator is the single mind of the market. It is the flow of the direction of the market. So these are the brains of the market in which the market direction derives from their campaign. So if we look at the opening of the S&P 500 yesterday in the day session, which is 8:30 in Chicago time, and Midwest time in the United States, we will see that the market here has, this is the opening here, has the 8:30 opening. We have volume that usually increase on the opening because there's buyers, sellers on the opening as the market opens. And the first instinct is the market rallies up. Now remember, the previous day we'd come from weakness on the daily chart. So we had a downward bias to the market overall in the background. Market goes up, and we see a reactionary high here, comes back down. We want to draw the line across from here. This is what we call an up thrust, or a penetration of a previous high and a close under it. So we call this an up thrust of previous resistance. And we put our line and we label this as an up thrust. The market comes down, we get the appropriate selling from this area. The market has a retest, but we do not get bullish until we make a new high for trend, which we have not done. So the market comes back down. This looks friendly, but it's not taken out. Our stop, for all practical purposes, would be above this line, but we don't want to keep it too close to get jabbed out. So we can put our appropriate risk stop maybe above this area. If we sold the market here at 26.33 and our stop becomes 26.38, it's approximately 250 points, 250 points S&P, about $250 risk, about 5 handles or 500 points, $250. Now obviously there could be slippage in the market, there could be a market that has some fast market conditions and the stop may not get hit, but our stop placement would be $50 from our point of entry. When a stop order gets executed, it becomes a market order. So it can or cannot be filled, depending upon the condition of the market, but generally with liquid markets, in markets that trade a lot of contracts, it's sometimes, well, it's never. It's usually, under most circumstances, not an issue, not a problem. Market comes back down, and the market comes back down, and we react to it, and then we have a reactionary low here. We want to mark the bar right here. This forms a little trading range that we spoke about in the previous YouTube webinar sessions, and this forms a trading range to the market. The market comes back down. We don't see any demand. The market stays near here, goes lower, goes down lower, and then the market then has a reactionary move up. This is the market broke out from the downside. This little range here. We mark this bar across here. Here's another up thrust in the market, a possible edge for entry with a stop above here. Another retest of an area, edge here. So I'm just showing the edges of where trades could have been taken yesterday with a minimum amount of risk. At least a minimum amount of stop loss risk. Okay. Now the market's been very volatile and very moving, so we always have to be careful. Market breaks back down again. We then have a market that then has another area. So we place our area of resistance with the marked down bar here. These are edges in the market that could have allowed edges to be taken of trades with appropriate losses above. And the market continues to go down all day long. So if you just follow the edges, follow retest of previous highs in a downtrending market, they're a lot of times effective to look for edges for the trade. It may not be your cup of tea per se. In trading the market, you see the close off there, some selling, but these are edges to Wyckoff and where you'd like to look to make trades. Where to make trades. Okay? These are all edges to look for. It's a downtrending market. We see lower highs and lower lows. We see a market that's in a weakened position. So the appropriateness of selling rallies in a bearish market will, I believe, have better odds in making money than not making money. Again, 90% of people lose money in trading. So it puts the odds a little bit better in your favor. How much so, we never know because they're markets. We always run the risk of the market going much higher or much lower for the area-wise and stuff. But the bottom line is that the market at this point acts the way it acts as far as the negativity to the market. So a downtrending market, lower lows, lower highs, with no demands to the market, and then we go from there. So I just want to mention to you where the market has these areas to look for areas to sell. So I want to wish everybody a good, safe weekend. A short little video of the edges of the S&P, the E-mini, S&P 500 chart. And this was for December 14th, 2018. So this is December chart. This is the chart from December 14th, yesterday, Friday. In the E-mini S&P contract, daily chart. I'm sorry, it's a 5-minute chart. The 5-minute chart. Short-term trades, short-term chart. And I hope you enjoyed this little video. If you want to join us, there's more YouTubes out there. Our website is www.ltg-trading.com. My Skype is gary.fullet. And the email address, if you'd like to email me, is gfullet, F-U-L-L-E-T-T, at ltg-trading.com. So I hope you enjoyed this little short presentation of where to look for edges in markets. There's a lot more edges as far as detail of markets are concerned, and be happy to help and ask any and all questions if you like. We have a live chat room during the day that we talk about markets. You go to the public room. We have live webinars that are free Sunday evenings at Sunday night at 8 p.m. Chicago time. That's free. You come to the LTG Trading public room and just chat, log in, and you're there. So hopefully you see everyone tomorrow night, 8 o'clock Chicago time, 8 p.m. And everyone have a great day and a great evening, and happy holidays. And the best of 2019. Thank you so much. Bye for now.